Folks, now my next guest says that the bear case against tech makes no sense, right? And it can't be so, put it this way, it can't be so insignificant and that all of the spending is a waste, but at the same time, it's so scary that it's disrupting every business, right? They both can't be right. Infrastructure Capital Management CIO Jay Hatfield with us. Jay, before we get into the madness and hypocrisy, just real quick, I want to get your thoughts because you look at the broad economy. CPI number I know felt like irrelevant with the future numbers coming out, but we've been heading in the right direction.
Mm-hmm. Thanks, Charles. Well, yeah, absolutely, and it's important to note that if you measure real inflation, trueflation, or we publish realflation, it's already below 2. But the problem is that the two key leading indicators of inflation are oil prices and money supply. Money supply is down. Obviously, oil prices are huge. So the Fed's going to be on hold until the Strait of Hormuz opens.
Let's talk about the short answers on technology. Tech stocks, for whatever reason, for the most part, have been getting hit here a little bit, certain parts of them. But here recently, the short interest has gone absolutely through the roof. Mm-hmm. I like when this happens. I start looking at my chops because I see this, I'm thinking short squeeze at some point.
Absolutely, and this happens when earnings season is over. But earnings season produces real information. You saw it from all of the infrastructure providers. We think that's the lowest risk area to be in because there's clearly going to be a lot of applications. So we know that infrastructure is going to be used. Marvell blew out their earnings. Oracle blew out their earnings. Broadcom blew out their earnings. So earnings is the real discipline. And last point, that there was a rotation because the Fed was going to cut. Now the Fed's on hold. So that rotation should stop, and we think tech will do better.
One tech name you just mentioned, Oracle, obviously it had gotten hammered pretty good, having a pretty good day today. I know at one point you owned it. Would you be a buyer here?
We owned it in our hedge fund. We have a small position in PFFA, our preferred stock fund, because they issued a big mandatory. And we liked it. We liked to go into the print. And it was super positive because both short theses were disproven. First of all, the SaaS integrated providers are not being displaced. They're actually probably stronger.
Being augmented.
Right. Well, because, I don't really never understood it. Like, we're not going to go write our own Outlook, and these are much more complicated businesses than ours. So they can't get rid of Oracle. So that was ridiculous. And their cloud business is improving and the CapEx is coming down because they're getting the clients to pay for it. Mm-hmm. So both of those short theses were blown up, and the stock is probably in a short covering rally now.
I'll ask you about another stock here, Amazon. Again, it's one of these names where it's sort of been sideways for a long time, even while the rest of Mag 7 were still working.
This is the poster child for over rotation to other stocks. Walmart trades at 44 times earnings. This trades at 20. This grows twice Walmart does. So the PEG of Walmart's 4 times Amazon. Huge buy, and also not that risky, 1.4 beta. So if you buy it and the market gets hit because of the war, go down a little, but not a lot. So we think it's a good entry point for Amazon.
And obviously that means you love the risk reward. Just 15 seconds to go. Overall, what are you telling clients right now, with this market?
We're remaining bullish. We think the war has to end. Everybody in the world except Iran wants the Strait of Hormuz to open. It will open. We don't know exactly when, within a month, maybe two weeks. So stay the course and be bullish.
They want it to open too at some point. That's their only source of revenue, the only source. Jay, thanks a lot, my friend.